Today's topic, we're talking about what multifamily investors really want. And this topic is changing over time, but today's show is going to be a little different from last. We're going to be talking about what those, like all this that we do is for the investor taking the risk. And we're going to talk a little bit more about how you can create some competitive advantages to give them more of what they want. And if you're a multifamily investor, this is for you too, to really understand what these operators can do to make sure that your capital is protected and you're getting the yields that you desire in your portfolios. So before we want to dive into all this, I just want to welcome everybody. I do see all the people without the cameras. I do see you at least in there. Thank you for that. Love that you're back. I hope that these are valuable. This is designed to be productive. Again, it's not a broadcast, and it's designed to be a meeting. It's definitely not a broadcast, right? I mean, we do those virtual events, and it's us like CNBC pushing content to you. So I want to make sure you have time to bring your questions live here. So at the bottom here, you've been in a Zoom meeting before. There's a reactions button. I have opportunity to take those questions live when we get to the Q&A. Just click the, I think it's raise your hand or something like that. You can ask a question live. And I have Jim Miller here. He's on our team, and he's here to help with those questions. I also want to invite you to a Facebook group that we have for this group. And it's called, what is it? It's the Scaling Multifamily Brands Facebook group. So just go to Facebook. I think Jim can probably even put a link in the chat at some point. But this allows you guys to connect with each other, right? Continue the conversation. Also, we do some really cool behind the scenes things there, and we're just getting started, right? So that's something that you can do. That's at Facebook, Scaling Multifamily Brands. We're live here right now, so it'll give us some time to allow you to get accepted into the group, but definitely go there. So today we're talking about, again, what multifamily investors really want. And as an operator, before you make any day-to-day decisions, one of the things I advise people to do is ask yourself this one question. It guides any yes or no answer of the things that you need to do. And that is, what are the investment objectives? And every multifamily deal, as you know, it's structured in a very unique way, and it's getting even more and more complicated for these investors, right? And oftentimes, we make sort of general decisions. And what I mean by general is it's generalized based on your viewpoint or mindset around what should be done or shouldn't be done. And these decisions oftentimes are not based on investment objectives and not taking into consideration the specific property investment objectives. Because you can have an investor that has an objective, but inside this portfolio, this property has a specific objective. And so that's the first question that we need to ask. And sometimes you heard in the last event that we did last week, which was we approach an issue or identify a problem, and then we just go right to action. And so this is a good thing to just stop and just even ask, what are those investment objectives? So how does this happen, right, for people? I'll tell you, we essentially train people. And these people that are trained, they're the ones that are driving the returns at the site level, at where the customers are, where the renters are, the people that transact to allow us to achieve our returns. Now, as an investor, we need to know that. We talked last week about how Warren Buffett understands the customer and what's driving them and things like that. As investors, multifamily investors, we need to understand that, what those customers are doing. And as I've always said, that regional managers, this is the person that oversees 6 to 7 properties in a multifamily portfolio. I've always said that is probably the most important position in the operation of all of these things that we need to have happen. And the reason why is they're the wedge between that investment objective and the people on site that are going to drive the returns. Now, that regional manager's ability to collect the right people so that they can, rent faster. If they're hopefully they're teaching them how to think like an owner, right? And that maintenance department is not just walking by the leaky faucets and things like that, or letting the light at 2 p.m. stay on, and they're thinking like an owner. This is very important, as you know. Now, these are the people on site and at the property level that are likely going to be, when you push out a financial objective like a rent increase, they're going to be the first ones to object to it. Not always the customer. And it's usually our own team. So I'm going to talk a little bit more on rent increases later, right? But I want to just kind of give you an idea of like how this all looks. What we do is we bring these teams together. They get familiar. They get trained on how to make decisions, and we'll just call it like, let's say, Company A, right? They're trained with Company A within and then they're assigned to Property A, right? They have this organization with investment objectives. And then what happens is they do a good job. They get promoted. They're rewarded for their behavior and oftentimes written up in many cases in other ways. And then what they do is they get to a point in their career where they then teach others what they have learned. And in many cases, sometimes it's old strategies. And then what happens is a company is consolidated, or a seller sells a property and they're moving around and it's a fishbowl. And now this person that mindset has been shaped by Company A now moves into another role, and they move jobs. And now they're with Company B at Property B. You follow me on this? So what does Company B get? What does the investor at the destination job get, right? They get an employee that perhaps has learned strategies from Company A, the previous organization, with, by the way, different investment objectives, I would imagine. Not all are the same. So, I'm going to hold up this phone. I keep saying this is an iPhone. How many of you are familiar with Apple and PC? All of you are. But I ask the question because if you take an Apple user and you sit them down at a PC, what happens? Ask them to do something simple and they get stuck. Okay, my team's laughing at me right now, probably, right? I can walk any Apple user through any fix that they have without even being at the computer, because in my mind, I know, okay, go to settings, go to iCloud, do your thing, I can walk them through that. When we have two operating systems, as simple as even Apple and PC, you can see that you're trying to do the thing, but you can get lost in a system if it's not familiar. Now, you think about the taxi business, they were all individual franchises and different things, and some would take credit cards, some you had to have cash. This is long ago. But now Uber comes along. There's one system, and that scales very well. And it's a system that the customers use and the drivers use and the people that own Uber. I mean, it's all one system. Now, it took Google to lay out the roadmap to all that for that product to even be available. But running a business, there are very few companies that have their own operating system. This is not just like what accounting software do you use, but I'm talking about a thinking process that guides everything that they do. And so they may have worked for a developer and now you're a third-party manager. So in that case, you're going to get the value of like they're thinking like a builder, and right? What if you have a development and you have a third-party operator, which every decision got shot down because there was no budget to do the right thing for the long term? So what does all of this mean for the investors? It means that if there is a wide gap between investment objectives and the decisions that are made at the operational level or even the site level, then that can create some tension in the results that you're trying to create. Now, fast forwarding to to really now, I mean, deals are packaged and structured in such complex ways now. The funds and the syndications, you're not really seeing that founder-based investor. They're exiting the market, and this is just based on passing it on to generational family members beyond. But these are the founder-based multifamily investors that, in many cases, I've been trained by and had the opportunity to serve. But they were more legacy. They owned their portfolio, 5,000 units or 2,000 units, and there were not a lot of partners and syndications and complicated deal structures in place. And so they thought about the business with their investment objectives very differently. Deals are put together very different today. Investors, and oftentimes they're, it could be an insurance company. It could be 34th floor in a building, and they're looking at the money eyes. They don't really look at the fabric of the feeling of the customer. They're just looking at the math. And what do you have? You have operators that are designed to meet their pro formas. They have the real estate eyes. So you have this wide gap between these two people being aligned. And the closer they're aligned, the better we're going to get objectives handled. And successful, I mean, you guys know this, successful multifamily investing requires you to blend both the money eyes and the real estate eyes together. You can't know one or the other anymore. And asset managers and passive investors, even in today's market, they're being sold sort of this hands-off approach to the benefits of owning and investing in multifamily. What this means is you don't have property owners or investors walking the property, doing inspections, walking around and that founder-based investor coming up and giving you a punch list that the gutters are leaning, that the asphalt is not settling the way that they like to have it settled. You have these you have investors that sometimes look at things like, if they're a builder, right? They're a developer. They see the structure when they walk onto a property. They see the cracks in that asphalt. They see those gutters. Whereas others might not even have an eye for any of that detail, right? They're looking at the math, and or maybe they're just expressive and a different personality, and they're looking at how did the leasing team greet them when they were there, right? Which probably is the most important indicator of all of this stuff, right? Because if you lease and you rent, you have the resources, you take care of those gutters and stuff. Either way, basically, these expectations can be very unclear. And if you knew the investment objectives, if it's a long-term hold, you're now making a decision like, do we fix that gutter now or later, or things like that. And these are the things that drive your ability to protect capital over time or achieve those NOI growth goals. So what is it that multifamily investors really want? I think you need to look at it like when you talk about success. I think it's up to the person that's investing to determine that, right? It's just us. We need to ask. So the first answer to that question is ask them. As syndicators, operators, sponsors, deal makers, whatever, wherever you sit at the table, people are counting on us more than ever to execute those plans and achieve those stated NOI projections. And what I mean by that is, before, years ago, you would have, results follow focus, right? So if you ask questions, they'll focus on those things. But right now, these passive investors, the way these deals, there's no one driver of the thing. There's no one owner walking out saying, here's how I like to see things. And so that means, as operators and sponsors, it's our due diligence, it's our duty to take that lead, right? So how do we do all this, right? For years, we've helped owners achieve all of our NOI growth. That's that cash flow, by understanding I mean, just look, I want you to start paying attention to this as you're seeing things shared, even in social media. We're trying to achieve that NOI growth, that funds from operations or the net cash flow. And we're doing that with old fundamentals that are important, but they're all based off of supply and demand. I mean, you remember the old market demand reports about the radius, and you're 5 miles in and 2 miles out, and here's the demographics. All that's out because people are working in cities they don't even live in, and that radius due diligence stuff is done. You know, these fundamental supply-demand fundamentals, just focusing on that, it's basically allowed us to just understand, like, when is it the right time to grow rents? Is there enough demand? Can we push it? Should we build in that market? And solid rent growth in markets is healthy, right? People, if you were to buy a single-family home, they don't wave a badge of honor like, I bought the cheapest home. It's the opposite. But we're trying to drive rents, technically a high rent. I mean, I think Alex Rodriguez, I just saw a write-up that he bought or had to convince to get accepted or purchase a property in New York, and it's well located, obviously, and very hard to get to. And he was very proud of that, right? Investment objectives. Not everybody wants the lowest priced apartment. I know we have a lot of conversations around meeting demand and attainability and things like that, but the psychology of how we look at rent growth and how we get to the numbers for us is all changing. And the way I see it today is the problem in the deals today is that syndicators and developers, sponsors, joint ventures, whatever that is, they're promising these high returns, and you're seeing them. And now with crowdfunding, you're seeing them more. And those are 18%, 25% IRR from a multifamily asset that produces 4% cash flow, with the promise of a potential refinance or exit to meet that IRR. And that can be problematic, as you know. I mean, a lot of people have a lot of wealth and success doing that and a track record, but IRR can be manipulated. So we have to look at things differently. And you can't expect just the return to be met if there's a refinance or an exit. Because in a capital event, there's so many things that happen from how many people are exiting deals and how much capital is coming in, the rates of things, all of those things, but you don't want to have to rely on exiting at a certain time to meet your business objectives. Now, as syndicators, many times that's how they make their big pops, and that's how they're tied into the big money. And so I understand that, and that's awesome. And that's great, but just challenge the narrative and ask the questions. I don't see people talking about the renter customer and the renter's ability to, or even desire to pay the rents in those pro formas. Now, who do you know that builds a sustainable business, one that lasts through cycles, not knowing their customer, the renter? It doesn't happen. I mean, it has happened. There are investors that are rethinking even that 60-40 public market, where their returns, people are thinking differently about 401k money, and there's a flight to safety in housing, because the question is, well, I mean, imagine you have retail stocks or restaurant stocks, and people always need to have housing, so there's this chase to real estate. But then it's like, okay, well, not office and retail or malls, but renting. So there's this demand for our stuff, and if you're looking at supply and demand fundamentals, you would overestimate that demand in that, can they continue to pay for those things? Now that's some the sponsors or the syndicators, they're doing what we've always done. I'm not saying that's you. I'm just saying it's just kind of stop to think for a moment. We talked about first principles in our last event. We just go right to action, and we need to stop to think sometimes. So here's how it typically goes. We tie up a deal. We invest in capital in that deal to, interior improvements, fix some things. And by the way, those things are important, obviously, to keep properties at a level of care. But we invest in that capital into these deals with the intent to raise the rent. And then the business plan is let's just exit or keep it, refinance. And I get it. Like, look, that's worked. And there's a lot of people with a lot of results. I know it's worked. We've all executed on that. But here's what people are not thinking about. When that process is completed over 18 months and then another 18 months goes by because they sold it or refinanced it, flipped it to the next person, at each point you have a brokerage fee, you have a loan fee, you have lender fee, acquisition fee, disposition fees. You have all kinds of other things, construction management fees, maybe consulting fees, third-party inspection fees. So much load going into this program. And it's worked, right? It's worked because you put some money into it, you raise the rent, and you sell it to the next person. But what they're hoping for is that the renter can just continue just paying another rent increase. I'm going to buy it and I'm going to raise the rent. It's undermanaged. I mean, you know all the stories. The renter will do that until they can't. So here's the problem. If this continues and we continue to expect these investment programs to achieve these returns only when you raise rents, then at some point, and you already see it, this looming affordability problem places investment capital at risk, and it leaves the market, or it's regulation that enters. Money starts going to other places. Well, right now, I don't know, and don't quote me on this, but I think it was like $32 billion in prop tech funding in the last year. There's money going to other places for returns. Those technologies, in many cases, are making life better for people. Now, most multifamily investors, and I'm sure you and your teams, it's like when we create the kind of wealth we can create, we can impact the world and improve lives and do sustainable things and do things in the community and really pour into the hearts and minds of people. I get it. But multifamily investors, their business is to create a plan for wealth and achieve that. So that means if that's the goal, then let's look at one of the wealthiest people on the planet and how they look at it. I'll pick on Jeff Bezos, owner of Amazon or creator, and right? He plans his future knowing that the customer of the future will always want and desire lower costs of things and a very easy way to get that thing. If the multifamily industry looked at it differently, like, well, in our industry, the syndicator's plan is to make the customer pay more. And that's worked. And I get it. Look, I'm telling you, it worked, right? It has worked and it's good. But the point is that a sustainable plan? The auto industry we talked about in past shows. They have found ways to structure deals so people can enjoy better products, safer cars, and the product is really getting better. if you Google this, Google like lease payments. I think at some point people used to buy cars and then they're like, well, let's find a way to just let the customer pay for it a different way. Again, giving them access to the benefit of enjoying it, but not pricing them out. So they had to get real creative. And if you Google lease payments, I think like Honda increased payments on certain vehicles like the Pilot and what have you. But you look at like Toyota or something, and there's reports that their lease payments are down 14%. How do you run a business when you can lower the cost of things for customers, right? It's fascinating to pick on other industries because they have different sets of things. But I think you can understand that if your renter is expecting a rent increase, everything else in life is also going up. And that's important to understand. So what are we doing as multifamily operators and investors doing to essentially protect investments and also protect the customer? And looking at technology would be a great way to think about operating better or thinking in this first principle. We talked about that last week. I won't go into first principle thinking. I told you should Google it. It'll allow you to think about all the things that you do in your operations in different ways. But what we have to do is we have to change the perception with the media and our local communities so that we can get these projects approved. If we're going back to the basic supply and demand fundamentals, we need to be able to have the ability to meet that, right? So then we can control our positions on things. And when these projects, when they get approved, we now have to look at like, how do we build these homes more affordably? You're not going to ever solve affordable housing with supply only and demand. It needs to cost less to build this stuff. So what I'd like you to start thinking about, and it'll give you some great perspective on everything else that you're doing, is start tracking built tech. I mentioned sometimes in our last episodes about that. But they're building these things better and faster. And maybe you're not building today, but you can start to look at other ways to look at the business. Again, look, you may not be doing deals that are in development. You may be acquiring and stabilizing and things like that. But if we were practicing medicine today, there are people out there giving malpractice. That if you were doing medicine, you would be in malpractice lawsuits, right? Like when things are well, that's great, but when it's not, it's a problem. So I always look at it like, what is it? The quote, never give a prescription without proper diagnosis, right? And we're telling the proper diagnosis is like, what are your investment objectives? You're talking about meeting returns and all these things without even an understanding of the investment, the diagnosis, right? That's what I mean about the malpractice stuff, right? It's all good until the music stops and something like even COVID. Nobody saw that coming, right? So what do you do as an operator, as a sponsor? I want to talk to you guys about that today. What do you do as an innovator? You develop that product that you can actually help operators and investors. How do you serve this industry at the highest level? And the thing that I would call you to do and to think about, because I don't see anybody doing this in presentations, especially in the investment side, is to focus on that customer. We need to take on the burden of value engineering these properties that we already own or we're building. We can, and when I say like negotiate with your suppliers, I don't mean like just beat them up over price, right? Because they're partners and we need them. But we need to be thinking about is it supply chain or can we shop regionally, whatever those things are. But we got to think of the business more than just our goal is to raise rent and keep the occupancy up. There's money all around us to be found. And we need to start thinking in first principle, what does it cost to run an apartment community? Like, what does it take to actually provide housing? and just start testing every assumption about it. Does it take a leasing office? Does it take people? Does it take a tennis court? What does it take? Start testing every assumption about it, because I guarantee you at some point you were told something that it took that. And just like I mentioned about the demographics and supply and demand, about the radius, all that has now tested. If you're an operator, you can get your investors hurt if they're depending on double-digit rent increases to achieve their goals. And what I'm challenging you today to say and do is to be a business owner. And what you own is a real estate business. And that means you need to understand people, technology, the world that we're working through, the real world that is happening around us. And it's our obligation and duty to know how to run a profitable business. And again, that doesn't mean that the profit's going to come from just the renter. It has been, and it can be. And you're not going to have a lot of support on that, because everybody around you, they're operating on the same not accounting system, but like I mentioned, Apple and PC, everybody's on a system. They have a talk about the industry in certain ways, because we've been to certain events, we're part of certain trade associations. This is how it goes. But I can tell you, those associations and even the media that you see, they can't help you. That data that they're publishing won't help you. They're too connected to what has been. They're all circling the same information, and it just validates either their education or maybe even the past decisions that makes them feel good about maybe supply and demand fundamentals. You've seen this already. Look, I talked to you last week about how Elon Musk came into the auto industry, and there was literally their trade association created a campaign to say this is a bad thing for the industry. Okay? It's bad for business, bad for people, all that stuff, because the trade association had the wrong customer. They were trying to protect the dealer network, which is where the money was. They had self-interest, bias. And obviously, now they're all chasing Tesla. Now, if you're counting on them to change things, you're going to continue to see increased regulation and problems coming to us, because we haven't figured it out, because there is no Elon Musk saying to do the right thing. Maybe Jeff Bezos or Amazon buys, and you heard this in 2017 at our Innovation Summit, what happens if Google bought one of the big accounting systems and gave it away for free and got access to the customer and figured out how to work with Airbnb on something or something like there's all kinds of things that can shift things dramatically in a moment when the pain gets high enough. But the trade associations, your media, they're just stating things like, we're fighting this regulation. Well, the only people you're telling is the people within the industry. If you ask anybody in your family that is 2 steps from you, ask them anything about anything, those are the people voting. I challenge the media. We need to change the story, because children grow up thinking that developers come in and bulldoze trees and build things. It's in movies. It's in Hallmark movies. It's the property owners, the slumlord in TV, the wealthy person cashing $1 million checks. And that's not the people I spend time with. These are remarkable people that care about employees, care about the environment, care about things. But the deals have structured in such a way that there isn't a way through to really help without true leadership. So what we need to do is we need to focus on the brand of what it means to build community. This pandemic, COVID, it's a brand. We believe in it. Some don't, some do, right? That's all been, right? The big, bad, wealthy landlord is a brand. It's it's a brand that has hurt investments if you're not handling things properly. And I can tell you that the world that has been shaken by all this pandemic stuff, it's not going to go back to what it was. The supply and demand will not be the data that helps you guide your investment decisions. Of course, it is data you need, and it's obvious data. But every person that you're competing with, trying to find capital, trying to deal, they're telling everybody the same thing. Again, nobody's talking about the customer or where the world's going into. Shifting workplace experiences, people working remotely, people don't needing office spaces, things like that. So you need to understand the world we're living in. Work has changed for people. This lie of the American dream of owning a home and having a job for 30 years, it's all being tested. It's going away, right? It's placing demand on renting because people are like, well, wait a minute, I can live here and there and do some cool things and make money in different ways and not rely on one single flow of income. These are the people renting in your apartments that are driving yields. The build to rent, right? Shake up. Awesome customer experience. It's shifting the experience of people. People used to move out, right? Because they wanted a yard. Okay, now we can rent with a yard. And it can feel like a home. It looks like a home, nobody above you, all that stuff. It's all changing. And we as investors need to understand what's changing and pay attention to what's changing and what those customers that want to rent from us in the future care about. Now, why do I tell you all this? Is because investors that are structured in yields and spreadsheets and banking relationships, they're going to talk about IRR. They're going to talk about cash-on-cash returns. They're going to talk about the math. It's up to us as deal makers and sponsors and educators, really, to help them understand the future investors of the world. They need to be investing in products people want, guiding people through how to take care of those investments so that they can still get the returns that they expect and their structure with tax and all the things that make it all exciting. But we get the money and we get to that number in different ways. So it goes beyond the math and beyond the transaction. The vehicle that you drive, that steering wheel that sits in front of you, it's going away. We may not understand it, but that doesn't mean it won't work. It's going away. The first time I got, I'll tell you a story about Elon Musk here in a second, but first time I got into the car that gave me the backup camera, I was, one of these guys, right? And I was like, that was just weird for a while. And now I realize, like, if I look back, which we still do, right? I just have I can see everything with the camera. It's actually better. And Elon Musk believes that in the future, people will not even be allowed to drive 2-ton ramming machines. So he's already looking forward. We need to look forward because people, look, 1/3 of Americans rent. That number's growing. It's significant. But what I'm trying to do is elevate your role in this process. You're not just looking at rent rolls, cash-on-cash returns. You're literally running a building, a portfolio, a community that people interact with. It's also an opportunity to protect wealth for investors. And getting involved in the community, asking questions, allows you to do that and see what's happening and share those observations and insights, kind of like what I'm doing here, so that you can start to look different at other syndications that, when they're presenting them, they're just talking about the deal points, and you're talking about that as well. It matters, but then you give them a perspective. that smart apartment investors look forward. These are the investors that are, they're working for, they know that the return is the outcome, right? It's not the goal. The goal is to build this great company, this great business that builds properties or acquires properties, takes care of that real estate so that you generate this yield. These investors are counting on us. They're counting on you. Now, I spent a little more time, and I keep promising I won't do that, but I got on a roll there, so sorry if I went a little longer. I would like to open it up to questions or any comments, or let it settle with all that I dropped there, because there was a lot there. But we need to ask the questions, what are those investment objectives, and what do investors really care about? So Jim, I'm going to take a little drink of water here. And if you have a question, raise your hand. I know a lot of people submitted questions, but we're here for you today. So thank you.
Yeah, great talk. A lot of really good ideas in there, Patrick. Got my wheels turning. I can see there's several other people that watching the Zoom array here that you've got their wheels turning too. Love to hear some questions or comments. If you have one, go ahead and go to the reactions down below. Raise your hand, and I'll get you on, and we can chat a bit. I don't see anybody at this moment, so I'm going to go to the first question that we put together from the audience here. So the first one is, what are some unique ways for me to signal family offices?
Signal family offices?
Yeah, signal
so like
offices.
Yeah, multifamily offices and single family offices. Again, it goes back to that question we started with. What are the investment objectives? What do we know true about family offices? Is they think in longer term, right? So if you're coming to them with this fast approach, we're going to do this, and then we're going to exit, and then we'll find the next deal, and we're going to exit, and then we're going to get you this return. And so to me, that's signaling a little bit of like misalignment, maybe, depending on investment objectives. You need to know those parties involved. But if you're talking about, here's our plan, we're going to protect wealth in these ways, here's how we do that, here's what we do differently than probably the other presentations you're getting. We understand the customer, we understand where things are going. Here's our due diligence. Like you're really talking about the protection piece. So they have the capital, right? So it's a matter of, you tell them like, 7% cash on cash instead of 4% cash on cash, and one's riskier than the other. Like what's a family office going to do? Take a risk, right? They're going direct to the real estate. So I would be talking about things that reveal that you think long-term, that you take care of real estate and the investor, that you understand the customer, and that you say no to deals. I've always said, and some of these, I'll get like, hey, can you look at this deal type thing? And it's like, the best service I've provided has been the real estate you don't buy. And so when you can take that approach, I think those family offices care more about the strength of things than the sort of this exciting upside.
Okay, very good. Anybody else have any questions, comments? Go ahead and raise your hand.
So one thing I noticed about the investment groups is either A, everybody's living a fabulous life and they're all, like on the beach somewhere right now, and they're hearing us in audio, which is great. I'm happy for you. I need to learn a little bit from you probably, right? But what's interesting in that question you just said, like, how do I, find single family office or get the signals to these family office, wealth managers, things like that, is
right.
the fact that most people that are capable of supporting and helping people at that level are kind of like what we see in the trend in this group is like the camera's off and they're not sharing. And so what that means is if in meetings one to one you're having great success, now it's time to take that success at scale so other people can discover it. Similar to what I'm doing right here. I mean, there's people that reach out to me every time I do this, right? And then I'm going to clip it up and I want other people to be impacted by the things we do. And then that's how a family office would say, hey, listen, I managed the wealth for, I don't know, you too, let's say. And that hasn't happened for me. But my point is, you just never know. And they're going to be aligned with how you think and things like that. And so, but here's the advantage that you have today is most people aren't going to do like even what I'm doing. This is probably as far out as you need to go, but you could simply go on LinkedIn and share your ideas around these things that attract people that want to be part of those things. But everyone else is going to be retreated and shy about it. And part of that is because we've been told we can't do some of these things, right? So you always want to check based on your investment objectives and your deal structures, what you can say, what you can't say. But I'm talking about sharing how you think, your mindset, your viewpoint of the world, and maybe even talking about your team, your due diligence team, why your team looks different than any others because we focus on the long term, the founder story, all those things that give people the more trust and credibility. But I think that's pretty interesting. I'm noticing it in the group. So that's a way that you can wedge forward.
Can I put my hand up and make a
Greg,
comment?
yeah, go ahead. What you got going on?
So I think investors, we have to remember that investors, first of all, have options. and it's not to say that their first choice is multifamily. They have lots of options. They can put all sorts of real estate classes, stocks and bonds and otherwise. And I think investors, whether they're family offices or whomever, look for three things. And it's always the same three things. They're looking for returns that are equal to or greater than the risks they're taking. And we could say that that's called alpha. So they want to outperform relative to what a similar risk would be generating, whatever that is. And I like to say, because I do a lot of this, you can get a 5% return on a 3% risk, and that's a good deal for some investors. You can have a 15% return on a 20% risk, and that's not a good deal, frankly, for anyone. So investors are looking for three things. They're looking for risk-adjusted returns that outperform with best-in-class managers. Best-in-class managers, absolutely the most important thing in the equation of three things that I'm going to talk about. Best-in-class managers, people who have done this before, who have shown they can pivot, they have a track record. They may show that they've had some bad deals, but how they recaptured capital. There are very few investment deals. Well, there are very few investors who've been perfect all the time. So best-in-class management team that is aligned. We've talked about the returns, and the third thing, and frankly, it's the last thing, and that's in an appropriate structure, that these deals are in an appropriate structure. And I've seen this. You can have good structures with bad management. That's a bad outcome. You can have great management with okay structures, and that could be a very, very successful outcome. So those three things I think are important. The other thing I think is really important, I'll make one other comment, and then I'll turn it back. Multi-residential, I think, is still a very, very young asset class, and it's evolving. And we think of revenues as being rent, which they are. But there are other line items that I think we can create in this asset class, and that brings more alpha. And we've used the word community a couple of times. First of all, if you can create community, you can create sticky rents because people are going to want to stay for whatever reason. So what are the services that you're providing? And what is the hospitality component on what you're doing? Are you treating your tenant as a client? And are you giving them something extra that will cause them to stay and in fact pay higher rent? Second thing is part of community. How can you take a building or a cluster of buildings, create a community, and also aggregate the purchasing power of the residents? And if you look at an individual who pays 40 to 60% of their income in rent, that means 40 to 60% of their income goes to purchasing goods and services unrelated to rent. So how can we as a business aggregate the purchasing power of those individuals and create loyalty programs, create enhanced purchasing power for those people to go and buy insurance or groceries or dog walking services? And this is how we have to start to kind of reinvent real estate and create alpha. Because if we're only dependent upon rising rents, we're going to have a challenge. And we can do that as long as there is limited supply. And I think, Patrick, you said before, and I agree, real estate is supply and demand of two things. Simply stated, supply and demand of space, less space, more demand, rents go up. And the opposite happens. And the second is capital. And we're very fortunate that right now there's fairly abundant capital, pretty cheap. So I'll stop there. I mean, there are some comments that maybe can help the discussion.
Craig, so refreshing. Thank you for your remarks. I'm excited that you shared because, number one, the vision of everything that we're doing is all about extracting the knowledge from people that are doing wonderful things, creating healthy organizations, and then let others discover those ideas and creations. Because if you notice, I'm not a guru. This isn't about what I know. This is about bringing together our community here and listening to the things that you just shared are remarkable. And, you know, if it sparks somebody's interest into like, well, I never thought about it like that. This is what it's all about. So thank you for your remarks. Very refreshing. I'd love to invite you to, and this is more of this isn't a broadcast kind of thing, but it's we have the Multifamily Innovation Council, and what we're trying to do is get feedback from all the levels. We have the operators, the developers, even down to the maintenance and leasing, everybody's role in that process, so we can figure out what are those things that they're doing to run the business that we can then go back to technologists and say, we need to build something to make this more useful, if it's the rewards program, whatever that is. But such refreshing remarks. Thank you for being here today. All right, what do we have next, Jim? Do we have anybody else lined up? I mean, that was if we ended there, that would be a great show.
Yeah, I think you're right. I haven't seen anybody else raise their hands, so I'm going to go to the next question on our list from the participants that we got earlier. That question is, my biggest challenges are raising capital and finding investors, and that was from a development company.
Yeah, and so in last week's event, we went through the 5-step process to essentially accelerate trust and credibility. And in that process, that 5th step was that conversion, and a lot of people go right to that conversion. The way I look at it is a lot of people ask that question, right? And that also means that there's a lot of work not being done. There was 5 steps. So step 1 through 4 is not being done. And you're looking at it from if it's a syndication, it's like, well, I don't need to do that until I have a deal tied up. So I'm going to rush into trying finding capital. I can't find it, and you're rushing after it. If you're doing things in a more consistent way, long-term, and you're always raising capital, like you're always out there, like what Craig shared is refreshing, right? Like, I don't think he would have a problem raising capital if more people heard about how he sees the business, right? So you always want to have, like a railroad track, these things going on where you're stating things at scale so that people can discover you and learn how you see the business, and they're calling you. And you're still going to need to go after the things like you normally do when you have a deal in place and you have a fund to close or what have you. But if you invest in those steps 1 through 4 in getting the right signal, the right messages, if you're saying things that Craig just said about this is how we're creating alpha, here's how we're seeing the business, here's how we're looking at rents. The rents are important, but we look at it differently. You could literally restate back what Craig just shared, in a way that you're educating people on how you see the business, and all of a sudden people will want to be part of that. They want to be part of winning teams. It makes it sound easy. It's not. It doesn't happen overnight. But the good news is most people don't put in that work, and that's really where the advantage is. We all grow up seeing the Warren Buffetts in TV and his ideas and views, but I haven't met him. Have you met him? Right? But we have a pretty good idea about how he sees the world because he's talking about things. And, you could look at Kobe Bryant, who passed away and left a legacy. We kind of felt, again, that we knew him. And there was a lot of emotional hurt when that tragedy happened. But there was a transfer of knowledge to develop trust and credibility. And they had an advantage. They had media as an advantage. And they were able to get out in front of the media. But today, there's never been a better time with everybody having a TV in your pocket to go right to the viewers. So that last week's show is very important to give you a competitive advantage to raising capital. Craig, I saw you raise your hand. I'm happy to follow up.
Don't like this happens that these topics are things that I'm pretty familiar with. Raising capital is very hard. It's very hard. And I've been fortunate, like I've worked for investment banks and I've literally raised billions of dollars. And that's including not having succeeded on deals. And sometimes you get deals done because timing is good, and there are less good deals, and better deals don't get done because timing is less favorable. But when I approach somebody to raise capital, I say to them, the only reason that you won't do this is because you don't have liquidity at this moment in time for this strategy. Because we've got everything else right. Who's the management team? Have we done? Yes, we've done a criminal check on the people. Have we worked on the financial models? Yes, and we've stress tested the assumptions. Does it generate a return that's appropriate? Yes, we believe it does, and it's achievable. And we've actually been in the financial models. And then people will say, okay, if I do this, what's your role after I put my money in? And that's really a telltale question. Like, do you take a commission and go away? Do you have any tied to the performance? Are you paid in part by the performance of this, or do you take a fee off the table? And you better have good answers to all those questions. I actually have a 5-step advisory process that I have, and I published and put on my LinkedIn profile. And it talks about each of these stages. And the first stage before I take on an assignment to help a client is I do due diligence on them, and then I charge them for that. I want to see the criminal check. I want to know the worst deal they've done. And I may not talk about it, but I want to know about it. Has there been litigation? You better know that stuff, because it's like a right of first refusal on a building. You bring in an investor and he wants to do the deal, and you start your legal documentation and you find there's a right of first refusal in the 11th hour. That's pretty embarrassing. And you should have found that at the beginning. So you better do a lot of work before you make your first call. And you better be prepared to put your name on the line, because at the end of the day, whether you're raising capital or you're running a business, it's all about building a brand, building relationships, being true, being transparent, and delivering what you say you're going to do. In fact, you really want to overperform. I'll leave my comments there.
Craig, thank you so much. Another refreshing moment there. And I'll have to tell you, I'm proud of our team. The fact that you're here with us, like that's the exact thing that when you're spending time with the people that you want to spend time with. What I liked about what you said about, and you were even getting into the steps there, is the before, during, and after. Like a lot of people look at like, how do I get to the sale, or how do I get to the deal, to the yes? But customers, anything else, want to know that trust level is there. You just described it, right? Is after the sale, after the yes, what can I expect? And to the extent, for example, letting people know that, like, hey, after an investor, this is what happens. It could be a picture of you meeting with people in a conference room. on LinkedIn. And it could just be like spending time with the people that are supporting us. And it kind of gives the vision like after we commit or we form a structure together, this is how it's going to go. And then I loved how you dived into even the, how you rewarded and things like that around the process. I'd love to learn your 5 steps and invite you even into the Facebook group or to email me, whatever that may be. That would be wonderful to see those. That could be a really good educational piece. All right, Jim.
I put the link to the Facebook group in the chat. So if anybody wants to access it, it's there at the top. And we have a question from Tipsy. Tipsy, are you, there we go. Go ahead, Tipsy.
How you guys doing?
Welcome in.
Thank you. Great session, guys.
Thank you.
Quick question. So I actually have investors, but it's so hard to find deals. How do I overcome this? How do I find great deals? Where do I go? I'm subscribed to so many SaaS applications to look for leads, but it's just not working. You know, I went to Denver, Miami, this month actually, beginning of the month, and can't find anything. And so, what do you guys like? What are the strategies do you think I should adapt?
Yeah, and Craig talked about you're building a business and a brand, right? So let's just start with the more people that know you, the more people that can help you get what you want, right? So that's basic, right? And obvious and long term, takes time, all that. The other thing I would test is, and it goes back to how you're structuring things, but number one, I don't have an answer other than the marketing stuff that we've talked about and letting more people know about, how to get in touch with you, and then giving them the confidence, knowing like if what Craig said is after the yes is, that you're an investor that has the high probability of doing what you say you're going to do, and so people and brokers pay more attention to bringing you transactions that may, go to market early or even before market, things like that. So anything that you can do in the brand to know, like, listen, we're serious, we're focused, we don't do everything, but we do this thing. And when you find something like that, send it to me. But it just goes back into getting in front of more people and being clear about what you need. I'm looking for this type of property in this location with this unit mix, whatever that may be. So then you make it easy for them to think of you when they have something like that. And that may seem like fluff, and I know it's long-term and hard work. But I would also say, if you were thinking about things in first principles, build the units, right? Why find them? Build them. So if we know supply is needed, and so that's another thing to think about. And there's a lot involved there in costs and having the team and capabilities. But I know people that are doing that for, in many cases, with so much money chasing Class B properties, almost close to the numbers. And they now have a new property for the long-term wealth. So test your assumptions about everything that you're doing. And that's what I just did with you. I'm like, well, why are you trying to find the deal? Build the deal. Right. So think differently about it, and then invest in the brand and give people an idea around what it would be like if they did bring you a deal. Are you ready for the deal? Do you have do you have the structure in place? Do you have the legal team in place? Can you write an offer quick? All that stuff, and increase that trust and credibility, and then follow all the other players that are finding deals. And then go outside your market and just ask someone for advice. Like, what are you doing to find deals? And be curious and ask.
Awesome. Thank you so much. Yeah, I've been trying to build my network, trying to figure out some planners, trying to, just doing my due diligence in that way. But I have no experience with building. So I'm just trying to connect with people. But yeah. We'll keep doing it. We'll keep grinding. Thanks again, guys, for letting me speak.
Absolutely. And this is the first step to that. You just told everybody here, you need a deal, right? So, but I'm going to go back to Craig, and here's some, he tipped
I have
his,
a comment on this.
yes.
And there's more money than there are good places to put it. First of all, there's more money than there are good places to put it. So you have to be selective on the places to put it. But if you have money, Tipsy, you maybe, I don't know if you know how to develop or have ever done development. Maybe that's not your skill set. And I can understand that you may not know how to do that. What you should think about is approaching a developer to partner with a developer. I have capital. You know how to develop. Let's do a deal together. Be proactive in selecting the developer, because I can tell you, developers on balance don't have money. Developers don't have capital. And they use leverage, and the bigger developers have multiple projects, so they use their capital. And what I'm saying is it's very known in the industry. Developers are typically undercapitalized. So go to the developer that you want to deal with, who's a best-in-class developer, and say, I have my capital. And then you're really creating value between the capital, who's depending on you, and the developer that's looking for capital. You don't have to be the developer. You can share in the economics as the person that's structured it, brought it together. But there's a great opportunity for you to be proactive to find the deals that you want to do. Do that.
Okay. Awesome. No, I will. I actually am looking for, we went to look at a land for potential RV park. Didn't work out. Somebody put in cash offer. And, so those are the things that I'm navigating around. But I will for sure, yeah, that's the thing I'm focused on right now, just making connections with developers.
Look at the biggest competitor in that space. Find a competitor that owns RV parks and say, we'd like to do one with you. We have the capital for you to do this again. You can manage it. You can work out your business deal. You might even get a share of the management economics. But let's buy another one. You know where they are. You're more competitive in buying than we are, but we're going to provide the capital to you. And you can work it so that you're not really diluting their business. You're just providing additional equity that they might not otherwise have access to. Now, they may say, we already have enough money. So fine. You say, well, let's do this on a one-off in a special vehicle. Or they may say, well, that's a great idea because we're limited in the amount of capital we have to buy another property. So make the deal happen, because typically they don't come to you. You have to go out and create it. You have to start a dialogue. And you may end up doing a very different deal, frankly, once you get into a dialogue. Good things come out of dialogues. Good things don't come out of not speaking to people. If you have great ideas and you're in a room by yourself, that's the proverbial existential situation where nobody knows that you're smart and are prepared to do something. So start a dialogue on behalf of your capital, but ask your capital if they would be prepared to work through you to do a deal in a particular asset class. Say, I'm working on some things, Mr. Capital relationship. Are you interested in maybe doing a joint venture if I can bring that deal to you? And then you go out and make the deal happen.
Wow, that's a great advice, actually. And approaching competitors, will that work?
Well, I think like in anything else, you have to be as transparent as appropriate without being dishonest. Like, what is it that you're saying? You've got to be careful about managing your conflicts. And I would argue that if you will have no conflicts if you're not in the traffic. You want to be in the traffic where you're managing conflicts. And there are certain things that you'll disclose and certain things that you won't disclose. But conflict is not in itself a bad thing. The lack of disclosure of a real conflict is a bad thing. That's inappropriate. So you have to use your judgment. And that's part of building your brand, is that you're known as being an honest, tough negotiator. Honest is fine. Tough is fine. Dishonest is not good. Weak is not good. Remember, a business deal, I've said this so many times to the people I work with, a business deal, remember, you have two sides. One side's trying to minimize what they pay, and the other side's trying to maximize what they sell for. So most business deals only start when they come apart, because that's where you figure out the tension point between the two parties. because both parties are probably not getting exactly what they want. One's maybe paying a little more than they wanted, one's maybe getting a little less. And that's the starting point. And you have to be prepared to work with tension, create tension, and know that some deals fall apart because they just were never meant to be. But a good deal is what comes out of the point of tension, and that you know that you can move forward and actually make a deal for both parties.
Very cool.
Awesome. I love that so many great things came out of that, right? Tipsy, for the conversation that you put forward here. And Craig, thank you for showing up in such a way to essentially mentor at scale. I love it. We appreciate those remarks, and they're very refreshing.
My pleasure. This is fun. I enjoy this. This is our business, right?
Yes.
We better make it work.
Better make it work.
Fun. If we don't have fun, then it's kind of a waste of time.
That's right. That's right. There's a video I watched. I can't remember if it was Wharton or Harvard Business School. I can't remember where I was watching it, but he described sort of the formula for getting a message through, right? And it was, he drew up a K, a P, and a T. And the K meant knowledge, and the P, and the K was large, and the P was smaller than the K, and then the T was almost like an eighth of the size of the other letters. And they stand for knowledge, practice, and then T was your talents. And having the knowledge, like what you just mentioned about connecting and getting the dialogue together, getting the reps up. If you're in sports, lots of reps. If you're playing tennis or baseball or golf, whatever it is, and in getting out there and doing the deal or even having the conversation is the P part, the practice. Because I was mentored by a billionaire who became one of the 700th richest people in the world, and he was a developer. And he didn't start off as a developer. He was counting cars at intersections, and he figured out how to go to gas stations and say, hey, I've got some traffic here. And he figured it out as a business person, as you described. But what he did is he had the capital and he got the people together, and then he started building. And they taught him everything. The builders, they'd tell you, well, why are we doing that? And then be curious. Why do we need to do, and well, your first framing walk, walk it, and then ask all the questions. And that practice is the most special education that you can get. And I know, Craig, from your remarks, I know I can tell that you've had that practice, but also are great at sharing it. So I appreciate what you're doing there at scale. Well, we are coming up past our time. I'm happy to stick around for a little bit. I actually do have another call I've got to get to, but I want to invite you guys all back on Facebook. It's set up in such a way for us to reach people easily there, and that's Scaling Multifamily Brands. If you're enjoying this, let us know when you get there, maybe what you learned. We're going to be doing some behind the scenes things there that'll allow you to, connect better, but also, reach your goals, whatever those may be for you. So appreciate you guys all being here again. You can go to mclients.com. We have last week's show posted. If you missed that, you can see that. If you'd like to connect with us, there's an easy way to do that as well. But appreciate you guys all for joining us today live again. It's been another refreshing comment. And Jim, thank you for bringing us all together. Thank you.
My pleasure, Patrick. It's always fun.
Yeah.
Thanks, Greg, for all your comments. It's great stuff. And Titsy, awesome job.